All right, let's dive right in. Today, we're going to unlock a piece of the financial puzzle that trips up so many people, even the pros, the deferred tax liability. I promise once you get this, you'll never look at a balance sheet the same way again.
So, have you ever been scanning a company's financials and you see this massive liability? I mean, it can be billions of dollars, but it's not a loan and there's no clear due date. What is that thing? Well, today we're going to solve that exact mystery.
So, what is it? A deferred tax liability, or DTL for short, is basically an IOU to the taxman. It's an accounting entry that says, hey, we know we're going to have to pay tax on this income, eventually. And the whole reason it even exists comes down to one simple idea: timing. Now, to really get this, you have to understand that big companies are kind of living in two different financial worlds at the same time. They're creating two separate sets of books, each with its own rule book, and more importantly, its own goal. And this slide, this right here, is the heart of the matter. Just look at the two columns. On one side, for investors, the whole point is to show a smooth, steady picture of how the business is really doing over the long haul. But for the government, nope, they just want to know one thing. How much tax do you owe us this year, period? These two different goals mean you get two different sets of numbers. See, the rules for investors are based on what's called the accrual principle. All that means is that you record money when you earn it and expenses when you rack them up, not necessarily when cash physically changes hands. It's all about matching revenues and expenses to give a true picture of the company's health in a specific period. So how do these two different rule books actually lead to this future tax bill? Let's get into the nuts and bolts of how a deferred tax liability is actually born on the balance sheet. Okay, for any company that relies on a lot of heavy, expensive equipment, we're talking manufacturers, airlines, energy companies, the number one cause by a long shot is depreciation. It is the perfect example of where these two rule books go in totally different directions. Let's just walk through it. A company buys a $1 million machine. For its investors, it wants to look smooth and predictable, so it spreads that cost out evenly over 10 years. Simple enough. But for tax purposes, the government often lets them take a huge chunk of that expense right away to encourage investment. So in year one, their taxable profit is way lower than the profit they show to investors. And that gap, that $150,000 difference, boom, that's what creates the DTL. The company's basically saying, we got a tax break now, but we'll have to pay up later. I love this way of thinking about it. By taking that bigger deduction today, the company gets a tax shield. It pays less cash in taxes right now. But it's not a free lunch, It's really just borrowing a tax break from future years, and the DTL is the line item that keeps track of that loan.
And hey, it's not just about depreciation. Another classic case is an installment sale. Say a company sells something on a payment plan. For investors, following accrual rules, they have to book the entire profit right when the sale happens. But for tax purposes, they often only pay tax on the profit as the cash actually comes in. So again, you get this temporary difference, a DTL is created, and it slowly goes away as the customer pays their bill. Okay, this brings us to a huge debate among financial analysts, and this is where it gets really interesting. We know what a DTL is, we know how it's made, but what is it really? How are we supposed to think about this sort of phantom liability when we're trying to figure out if a company is a good investment? This really is the million-dollar question, isn't it? Should we treat it like a regular debt, just like a bank loan? Or, since it might never get paid back for a growing company, is it more like a permanent source of capital, kind of like equity? Or is it so weird and uncertain that we should just ignore it when we do our analysis? Well, smart analysts will tell you there are three ways to look at it. One, if a company's slowing down and not investing as much, that DTL is probably going to start reversing soon. That's a real cash payment coming up, so you should treat it as debt. Two, but what about a fast-growing company that's always buying new stuff? Its DTL balance might just keep growing forever. In that case, it acts like a permanent interest-free loan from the government, so you can treat it as equity. And then there's option three. Sometimes it's just so hard to predict when or if it will reverse that some analysts just pull it out of their calculations altogether. So the bottom line is this: there is no single right answer here. How you should treat a deferred tax liability depends entirely on the company's situation and where it's headed. You have to know the context. It's everything. All right, let's move away from the accounting theory for a second and connect this to what really matters most to any business: cash flow. How does this DTL account going up and down actually impact the cash in a company's bank account? Okay, so let's take the first scenario. You're looking at a company and its DTL balance is getting bigger and bigger every year.
What does that tell you about its cash? It's a source of cash. Yeah, I know, it sounds backwards, right? A liability is a source of cash, but think it through. The company put a tax expense on its income statement, which made its profit look lower, but it hasn't actually paid all of that tax in cash yet. That unpaid tax is cash that gets to stay inside the company, working for the business. Now, let's flip it around. What happens when you see that DTL balance start to shrink? It's a use of cash. This means those old timing differences are coming home to roost. The company is now paying cash taxes today for profits it actually reported in past years. That IOU is finally coming due, and cash is flowing out the door to the taxman. So let's bring this all home. When you're looking at a balance sheet and you see that line, Deferred Tax Liabilities, what is it really telling you? What's the secret? A big and growing DTL isn't just some random accounting number. It's a footprint. It's a story that tells you this company has been investing heavily, buying new assets, and using the tax code smartly to hold on to its cash. It's a direct reflection of its strategy. And this is exactly why this matters. When you can read the DTL, you can see behind the curtain of the reported net income. You can start to understand the true cash dynamics of a business and see how much of its profit is being driven by these timing differences. You know, this quote here really just nails it. A DTL isn't just one thing. It's a window into the company's past investment choices, a measure of its current tax savvy, and a clue about its future cash needs. It ties it all together. So the next time you see a deferred tax liability, don't just skip over it. See the story it's telling you. And that makes me wonder, now that you can decode this story, what other hidden narratives are just waiting for you in those financial statements?